Good morning, everyone. If you are able to hear my voice and if the PDF is readable to you, if you are able to read the PDF, please type all okay in the chat that audio and video is okay so that we can begin with today's session. Are you able to hear my voice and am I audible to you and are you able to see the slide clearly which I am showing on the screen? If everything is okay, please type okay in the chat. You can see there is a chat box on your screen. Please type everything is okay so that we can start with our today's MCQ session. Okay, yeah, I think everything is okay. So now let's start our today's session. Hello everyone and welcome to our live session. I am excited to dive into some thought provoking multiple choice question with you today. As we go through each question, I will ask you some quick yes or no question in the chat to keep everyone involved. So get ready to type in your answer. So let's start with the first question that we have. So the first question, this is our live session number 8. The first question is, as you can see on your screen, and you know that the recording of this session is available on our course, right? And I share the PDF also. Now let's start with the first question that we have. So the question says that, so this is a kind of case study like question. Some scenario has been presented before you and you have to answer the question based on the scenario. So let's start with the question. ABC Export, a company dealing in garments. So AV Export is a company dealing in a garment export, availed a packing credit loan of 40 lakh from XYZ Bank. Right. So PCL, this company has availed PCL of 40 lakh from XYZ Bank to fulfill an export order. The shipment was successfully completed. An export bill was submitted to the bank. However, XYZ Bank allowed the post-shipment document to be sent on a collection basis without adjusting the PCL. Additionally, ABC Export used proceeds from a separate export order to settle the PCL and did not disclose that they had availed packing credit from other bank for the same export proceed. So this is the scenario. Three things are happening here, right? So what is the first thing that he availed the ABC Export avail a PCL packing credit loan from XYZ Bank. Now shipment was completed. Now XYZ Bank allowed the post shipment document to be sent on a collection basis without adjusting the PCL. And the third thing which happened is that ABC Export used proceed from a separate export order to settle the PCL. Now, let's see the first question. I request you to please take a screenshot of the slide, right? Because you know, most of the time we will use the data which is provided in this particular slide. So let's see the first question based on this case study. Right now we are in unit number 5 of BFM. The first question is, what is the appropriate way to liquidate a packing credit loan after goods have been shipped? Very nice question. That the what should be the appropriate way to liquidate a packing credit loan after the goods have been shipped? So let's see the option. The first options are option A, allowing post shipment document to be sent on a collection basis without adjusting the PCL. Option B, liquidating the PCL by allowing post shipment finance against export bill. Option C, continuing the PCL even after shipment is completed. Option D, using export proceeds from another shipment against which packing credit is availed with other bank. So this is the question. I hope you have all have read the question properly. Now, let me ask you one question. So, before we dive into the explanation, I have a quick yes or no question for you all. Do you think that the correct liquidation method involve direct adjusting the loan with the export bill? Type yes or no. Do you think that the correct liquidation method involve directly adjusting the loan with the export bill? Yes. So one response I am getting is yes. Okay, so great. I see a lot of yes response. Thank you for engaging. Yes, correct. Yes, obviously, the correct liquidation method involved directly adjusting the loan with the export bill. Correct. Now, let's break down this what this question is asking. Right. The core issue here is about liquidating the packing credit loan. You can clearly see what is the core issue here. The core issue here is about the liquidating the packing credit loan. Let me show you. Here it is. It is about the liquidating a packing credit loan, that is called PCL, right? After the goods have been shipped. Now, option A suggests that allowing post shipment document to be sent on a collection basis without adjusting the PCL. However, doing this means that bank is not closing out the loan properly, because if we post shipment, if we allow the post shipment of the document to be sent on a collection basis, it clearly means that bank is not closing out the loan properly, which expose it to the credit risk and leave the loan unrecovered under the WTPCG. You know what is WTPCG? See, this is a kind of MCQ session, but I will make your concept clear. Our main objective is to have a conceptual clarity. That is why I'm explaining each and every option. So again, I'm repeating. The option A suggests that allowing post-shipment document to be sent on a collection basis without adjusting the PCL. However, doing this means that bank is not closing out the loan properly, right? Which expose it to credit risk and leave the loan uncovered under the WTPCG. What is WTPCG? Can anyone write down the full form? I'm also writing. The full form of WTPCG is watch list of trade, and post shipment credit guarantee. I think you all know about this WTPCG. We have covered it in the theory section. Watch list of trade and post shipment credit guarantee. So that is why option A is wrong, right? Because if we do such, bank is not closing out the loan properly, and obviously bank is exposed to the credit risk. So this is not an appropriate way. So option A is wrong. Now let's see the option number B. What option number B suggests? Let's see it. So option number B suggests liquidating the PCL by allowing post shipment finance against export bill. So this option proposes liquidating the PCL by allowing post shipment finance against the export bill. You know that this method ensures that once the shipment is completed, the bank adjusts the credit using the export bill as security. And this is the correct procedure. Yes, Ravanan, your answer is exactly correct. Very nice. Nice to see that you have answered correctly. You have a conceptual clarity over it. Option number B is the correct answer to this particular question. Right. Again, I'm repeating that what option number B suggests? Option number B suggests that liquidating the PCL by allowing post shipment finance against the export bill. This is correct. Why? Because this method ensures that once the shipment is complete, suppose shipment has completed, right? The bank adjusts the credit using the export bill as security. So this is the correct procedure. Option C says that continuing the PCL even after the shipment is completed. So this is option number C. See, if you continue the PCL even after the shipment is complete, this does not resolve the underlying risk, as the bank remain exposed without proper liquidation. So that is why C is also wrong. And option D says that using export proceeds from another shipment against which packing credit is availed with another bank. So it further complicates the financial picture and can lead to duplication of credit. That is why option number B is the correct answer. Now, one question for you. Yeah, type yes or no in the chat. Is liquidating the PCL by allowing post shipment finance against export bill the safest and most appropriate method? Type your answer, yes or no. What do you think? My question is liquidating the PCL by allowing post shipment finance against export bill the safest and the most appropriate method? See friends, if you want me to talk in Hindi, because there are some person from South who feel difficulty in understanding Hindi. That is why I'm going in English, because this English language can help both of you, right? Either you're from North or South, doesn't matter, right? So my question, listen to my question properly. Is liquidating the PCL by allowing post shipment finance against export bill the safest and most appropriate method? Yes, yes, obviously, obviously. Just now we have talked about it. Just now we have talked about it. This is the. What do you think? That option B is indeed the great correct option, because it ensures that bank risk is minimized by properly adjusting the loan against the export bill. Right. So that is why option B is the perfect answer here. Yes, live class, the recording of live class is stored in the course, right? It is available in the course. You can watch it anytime as per your convenience, right? To summarize, the key takeaway is that a packing credit loan should be liquidated by allowing post shipment finance against export bill, right? So you can see the answer of this question. The answer is here. The correct answer is option number two, that packing credit loan should be liquidated by allowing post shipment finance against export bill, ensuring that bank's exposure is minimized and the credit is appropriately closed, right? So I hope this make your concept clear. Now let me show you the second question regarding the same case study. The second question is in front of your screen, as you can see. So let me read the question. What is the potential risk if a bank send post shipment document on a collection basis without adjusting the PCL? What is the risk that the bank is exposed to? So let's see the option A suggests the bank loses its cover under the WTPCG, that is whole turnover packing credit guarantee. Option B suggests exporter gain operational flexibility in fund management, reducing risk for the bank. Option C suggests the advance automatically convert to a domestic loan with penal interest rate. And option D suggests exporter become eligible for additional packing credit from other bank for the same process. So this is our next question. So what do you think? Please type whatever you think in the chat. So before we delve into the explanation, I would like to ask you a quick yes or no question to get your thought. Do you think that not adjusting the PCL could expose the bank to additional risk? Do you think that not adjusting the PCL, that is the packing credit loan, right, could expose the bank to an additional risk? Type yes or no in the chat. So is if the bank does not if the bank do not adjust the PCL, could it lead to the expose the bank to an additional risk? What do you think? Yes, obviously. Very nice. Thank you for participating. The correct answer is yes. Now let's break down the option and see what is the correct answer. The first option say that the bank loses it cover under the WTPCG, right? Whole turnover packing credit guarantee. So it states that bank lost its cover. When a bank send post shipment document on a collection basis without liquidating or adjusting the PCL, it fails to properly secure the advance with post shipment finance, right? It fails to properly secure the advance, and this oversight result in the bank losing its cover under WTPG. Obviously option A is the correct answer. Nice to see that all of you have got the correct answer. You have a conceptual clarity, very good, right? So that is why what happened, that this oversight result in a bank losing its cover under WTPCG, thereby exposing it to credit risk, right? And this is the key risk we want to avoid. Now option B suggests that exporter gain operational flexibility in the fund management, reducing risk for the bank. So which might imply a benefit. However, this is misleading because the primary concern here is the increased risk to the bank, not a reduction of the risk. And here what is written? Reduction of the risk. So this is wrong. Option C suggests the advance automatically convert to a domestic loan with penal interest rate. Here the claim is that the advance automatically convert to the domestic loan. This is not typically the case when documents are sent on a collection basis. Hence, such a conversion do not happen automatically. So this is also wrong. And option D suggests that exporter become eligible for additional packing credit from other bank for the same proceed. So finally, the idea is that exporter become eligible for additional packing credit for the same proceed, and this is not accurate in the context and does not directly relate to the risk of bank. So the correct answer is option number A. Option A is the correct answer. Now let me ask you one more question. Do you agree that failing to adjust the PCL exposes the bank to a significant risk by losing its WTPCG cover? Do you agree that failing to adjust the PCL exposes the bank to a significant risk? What do you think? Yes or no? My question is, do you agree that failing to adjust the packing credit loan exposes a bank to a significant risk by losing its WTPCG cover? Just type yes or no. That if a bank fail to adjust the PCL right, if the bank failed to adjust its PCL, it obviously, yes, correct, awesome, thank you for your input. Most of you agreed, which reinforced that option A is indeed the correct answer. So to summarize, let's summarize the fact which we have learned in this particular question. To summarize, if a bank send post shipment document on a collection basis without adjusting the PCL, that is packing credit loan, it loses its cover under the WTPCG, thus increasing its exposure to the credit risk. This is a crucial point to remember while managing the PCL, right? So I hope this make your concept clear. Now let's jump to the next question. This is the third question of today's session, and this is very important because it was asked in the previous year BFM examination. So let me read it for you. The question says that, let me zoom little bit. Yeah, I hope this is fine now. Now the question says that XYZ Enterprise, an export firm with a strong track record, approached ABC Bank for a pre-shipment packing credit loan, that is PCL, under the running account facility. The firm has not yet lodged a firm export order or a letter of credit, but the bank, satisfied with the company's past performance, approved the request. Separately, XYZ Enterprise planned to export de-oiled cake. So here is the key point, de-oiled cake, for which they use locally purchased oilseed finance under the PCL. However, they delayed submitting the firm export order, and part of the proceeds from the local sale of oil was used to adjust the PCL. Please read it once or either take the screenshot of this slide. So what is happening that XYZ Enterprise approached ABC Bank for PCL. Firm had not yet lodged a firm export order, but the bank, satisfied with the company past performance, approved the request. So bank has approved the request. Separately, XYZ planned to export de-oiled cake, for which they use locally purchased oilseed finance under the PCL. However, they delayed submitting the firm export order. So this is the key point. They delayed submitting the firm export order. Please take the screenshot of this slide because the case study, this is the case study. The question we are going to see are based on this scenario, right? So I hope you have read it carefully. Now let me ask you first question. The first question is on your screen, as you can see. Let me show you. So this is the first question. Under what condition can a bank extend the running account facility for a pre-shipment credit to the exporter? So you might be aware of this running account facility. So the question is, under what condition can a bank extend the running account facility? Here are the options. Option 1 suggests, option 1 say that the exporter track record must be satisfactory. Option 2 say exporter must provide letter of credit or firm export order before the advance is granted. Option 3 say bank must insist on prior submission of a license for commodities under the restricted category. And option 4 says the need for the facility must be established to the satisfaction of the bank. So 5 options are there before you. 4 options are there. And you know, in this question, multiple option can be correct, right? It can be possible that 1 and 2, 2 and 3, more than one option can be correct. So type your thought in the chat, what you think is correct. Under which condition can bank extend the running account facility? So this was the scenario. This was the scenario. So before we dive into the answer, let me ask you a quick question. Do you think banks should require exporter to provide firm export order or LC before granting an advance? Do you think that banks should require exporter to provide firm export order or letter of credit before granting an advance? Or can there be some flexibility if the exporter has a strong track record? Please type a strict requirement. Please type a strict requirement or flexible in the chat. What do you think? Is there any flexibility for exporter having a strong track record, or the bank should require exporter to provide firm export order before granting an advance? What do you think? If you think that there should be a strict requirement, please type a strict requirement. And if you think that bank should give flexibility, you should type flexible. What do you think? So interestingly, I am seeing that many of you lean toward a strict requirement. Let me again rephrase my question. My question is, do you think that banks should require exporter to provide firm export order or letter of credit before granting in advance, or can there be some flexibility? So some of you are leaning toward flexible and some of you are leaning toward a strict requirement. So the correct answer is flexibility, right? Now let us go through the first option. The first option say that the exporter track record must be satisfactory, right? So while a good track record is important and certainly a factor in the bank decision, the option is a given expectation rather than a strict condition. In our example, let me show you the example just we have discussed. In our example, this XYZ enterprise did have a strong track record, clearly written. Here you can see this XYZ has a strong track record, right? But the key condition for extending the facility lies elsewhere, right? Do you think that a strong track record alone is enough to secure prepayment credit? What do you think? Do you think that a strong track record alone is sufficient? What do you think? Yes or no? Now, let us see the option number two. Obviously, it is no, right? A strong track record is not sufficient, right? So let's see the option number two. Option number two suggests that exporter must provide letter of credit or firm export order before the advance is granted. So this option might sound rigid, but the condition is that while exporter don't need to provide the LC or firm export order immediately before the advance is disbursed, they are required to submit in within the time frame which is specified by the bank, right? So this condition ensures that bank risk is mitigated even if there is some initial flexibility, right? So bank allows some delay in submitting this document. Remember it, bank gives some time, right? What is option number three? Option number three suggests bank must insist on prior submission of a license for commodity under the restricted category, right? So this condition apply only to the specific case involving commodities in restricted category and is not a general requirement. So it does not apply broadly to the scenario we are discussing here, right? And option 4 suggests the need for the facility must be established to the satisfaction of the bank. This is the key condition, right? The bank must be convinced that the exporter truly required the facility based on their export plan, cash flow, and overall business operation. So, in this particular case, which we are discussing, the XYZ enterprise delayed the firm export order. Clearly written here that this XYZ enterprise delayed, right? XYZ enterprise delayed the firm export order, right? So, the bank still need a solid justification for this facility. So, do you agree that the establishing the need for facility is crucial for risk management? What do you think? So, in this particular question, we can see that option 2 is correct. Why option 2 is correct? Because the bank allow flexibility in timing. Remember, bank gives some flexibility in timing, right? For submission of LC or firm export order. And option 4 is also correct. Why? Because the bank need to be convinced that there is a genuine need for facility before it can extend the credit. So option 2 and 4 both are correct, right? Option 2 and 4 both are correct in this particular question, right? So Does everyone feel clear about why option 2 and 4 are the right answer? Please type yes if you are following along, or no if you'd like further clarification. If you think that option 2 and 4 are correct, if you are satisfied, if you understand, then please type yes in the chat. Otherwise, I will again explain. Type no. Because there are two important concepts here, that what and under which condition can running account facility be granted to the exporter, right? So 2 and 4 both are correct. What do you think? Are you convinced that 2 and 4 are correct? Is this concept clear? If it is clear, please type yes, so that we can move to the next question. Yes. So here you can see that there are two important conditions to be fulfilled. That bank should give some time. That here flexibility is timing. This is the first point, and the second thing is that there should be genuine need for the facility before it can extend the credit. Two things must be fulfilled. Now let me move to the next question. Right. So this is the explanation of a running account facility. When the bank extended to the exporter, this is the condition. Now, this is the second part of the question. The second part of the question is, in which case can proceed from a local sale be used to liquidate a PCL? Right. So if you want to liquidate a PCL, then in which case proceed from a local sale can be used? So here are the option. Option 1, for any commodity export, provided the exporter submit a firm export order within 1 month. Option 2, when oil seed are purchased for exporting de-oiled cake and proceed from local oil sale are used within 30 days of the advance. Option 3, for commodities under the negative category, if the proceeds are adjusted within the bank policy period. And option 4, for selective credit commodity, provided LC are submitted within a reasonable period. So, in which case can proceed from local sale be used to liquidate a PCL? That is the question. So before we dive into this detail, I would like to ask you a quick question. Have you ever wondered why bank impose a specific timeline for adjusting a PCL using proceed from a local sale? Because if we take the proceed from local sale, then bank impose a specific timeline, right? So have you ever wondered that there is some timeline requirement? Obviously there is, right? So what do you think should be the correct answer to this particular question? In which case can proceed from local sale be used to liquidate a PCL? So let me go through the option. So the first option say, for any commodity export, provided the exporter submit a firm order within a month. So this option might seem plausible because firm export order are important. However, using proceed from a local sale to liquidate a PCL is not a blanket rule for every commodity to export. So do you think having a firm export order within 1 month is enough to justify using local sale proceed for any export commodity? What do you think? Do you think that I have taken a firm order within 1 month? Taking a firm order within 1 month is enough, is sufficient to justify using local sale proceed? Yes or no? What do you think? Obviously, it is no, right? It is no. So that is why option 1 is wrong. Now, option 2 says that when oil seeds are purchased for exporting de-oiled cake and proceed from local oil sale are used within 30 days of advance. Yes, this is the correct option. Because in this scenario, PCL is specifically sanctioned for the purchase of oil seed intended for exporting de-oiled cake. So why PCL is purchased? PCL is sanctioned for the purchase of oil seed. They want to purchase oil seed. That's why PCL was sanctioned. PCL, packing credit loan. This loan was sanctioned because to purchase oil seed, right? And for exporting de-oiled cake. From oil seed, they will prepare de-oiled cake. The key here is that the adjustment using the proceed from local oil sale must be made within the 30 days. This is the key point. 30 days of the advance, right? So you should understand that this 30-day timing is very critical in this situation, right? I hope this is clear. Now, option 3 say for commodity under the negative category, if the proceeds are adjusted within the bank policy period. So, although adjustment period are important, these options don't apply universally. Here the keyword is negative category. This negative category is not relevant to our scenario here, right? And last option say for selective credit commodity, provided letter of credit are submitted within a reasonable period. That means it states that for selective credit commodity, proceed from local sale can be used to liquidate a PCL. So this option again introduce another condition, but it does not directly address the scenario involving oil seed, right? So that is why option number 2 is the correct answer. So let us recap what we have discussed. The only scenario where proceed from a local sale can be used to liquidate a PCL is when, first thing, oil seeds are purchased for exporting de-oiled cake, and the second point is that proceed from the local oil sale are used within 30 days of the advance, right? So this is the condition. So please tell, does everyone feel clear about why option 2 is correct? Type yes if you are clear, or type no if you like more explanation or have any question. Yes, option 2 is perfectly correct in this particular question. If it is clear, please type yes. That what are the two conditions? That the first thing is that oil seed are purchased for exporting de-oil cake, and the proceed from local oil sale are used within 30 days of the advance. These two conditions must be fulfilled. It ensures that bank risk is managed effectively and aligning with their policy on pre-shipment credit. Tell me if it is clear. I hope it is clear, right? Please type yes in the chat. If you have done with this particular question, keep those response coming in the chat. So let us jump to the next question that we have. So the next question, as you can see here, it is. So this is now a conceptual question. Let us go through it. What it say that ABC Exports submit a demand bill or side bill in foreign currency to its bank on 10th March 2021, right? So a side bill was submitted by ABC Export to its bank on 10th March. Now, based on above, what is the notional due date for this side bill, and for how many days is the post shipment advance available at a concessional interest rate? Right. So the first option is, and option A say NDD April 4, 2021, and concessional period is 25 day. Option B say NDD 5 April 2021, concessional period is 26 day. Option C NDD March 25, 2021, and concessional period is 15 days. And option D NDD 4th April and concessional period is 26 days. So these are the four options provided before you, right? So what do you think is correct to this particular question? So before we jump to the explanation, I want to ask you a quick question. When you hear this side bill, right? When you hear this term side bill, clearly written, when you hear this term side bill, right? What do you think it implies before the due date? Type immediate if you think that payment is immediate, or type deferred if you think that there is some grace period. Type immediate in the chat if you think that payment is immediate, and type deferred if you think that there is some grace period allowed. Please share your response. When you see this word side bill, what do you think? Yes, I can see that. Great. I can see many of you mentioned. So you are mentioning immediate side bill. Yes, correct. Correct. Right. Demand bill means immediate payment. Obviously, it means immediate payment. Now, what about the question? Let us go through the option that we have. So option A says that NDD. So first of all, you have to understand that NDD means what? Notional due date, right? So can you tell me what is the NTP allowed? You have heard about this NTP, right? NTP is the notional time period or transit period, right? So can you tell me what is the NTP? How much NTP is provided by bank for demand or side bill? You know about it? Please type the number of days allowed. What is the NTP for a demand or side bill? It is how many? 25 days. Yes, correct. It is 25 days. right? So let's go through the first option that we have. In the first option, as you can see, just wait a minute, let me erase it. Right, so in the first option, if the ABC export submit the side bill on 10th March, when it submitted the side bill, it submitted the side bill on 10th March, you can see clearly written, right? So NDD is calculated as 25 days from the submission date. So starting from the 10th March, starting from the 10th March, if we add 25 day, tell me what date do we reach? So we will reach 4th April, isn't it? We will reach 4th April. 4th April 2021, right? So 4th April 2021. Now, if you talk about the concessional period, the bank provide the post shipment advance at a concessional interest rate for the entire NTP, which is 25 day in this case. So tell me what is the correct answer? Right, option A, I think clearly satisfy the condition, right? Isn't it? Because you see that if we add 25 day with 10 March, just add 25 day to 10 March, you will reach on 4th April. And that bank, for post shipment advance, the bank provide concessional interest rate for the entire NTP, which is 25 day. So option A is the correct answer. So tell me, I ask you one question. Why do you think the bank allow this 25-day period instead of requiring immediate settlement for a side bill? Type risk management if you believe it is for managing risk, or type operational reason if you think that it is due to processing time. My question is, why do you think bank allow this 25-day period instead of requiring immediate settlement? Type risk management if you think that it is about managing risk, or type operational reason if you think that it is due to processing time. Why this 25 days is allowed? Because why I'm asking you question for your conceptual clarity, because sometimes this question may be asked, right? So you should also give response that what is the reason why this 25-day period is allowed, whether it is for risk management or there is some operational reason. So option A is correct, right? In this particular question, processing time. No, no, no. The correct answer is risk management, right? Which is the key reason, right? So here it is. Here it is. The explanation. The explanation is that submission date is 10th March. NTP is 25 day. So the notional due date will be 10th March plus 25 will be 4th April, and advance is available at a concessional rate for the full 25 day, right? So is it clear? Is it clear why the correct answer is option number A? I hope it is clear. Let's move to the next question. Please type yes if it is clear. I will see. Let's see the next second question that we have. Right. The second question is in front of your screen. I hope the last question was clear, because once it is clear, then only you can go to this particular question. You can solve this one. Now let's see this question. Now the question is, XYZ Export submit a Yujan's bill in foreign currency to its bank on 15th June 2021. The bill carried a Yujan's period of 60 days. There is no grace period, right? What will the NDD for the Yujan's bill? And how many days will the concessional interest rate be applicable? Two questions are there. First thing, you have to calculate NDD, and second, you have to calculate the how many days will the concessional interest rate will be applicable. Option A say NDD is 5th, NDD is on August 14, and concessional period is 60 days. Option B say NDD is on 10th June, 10th July, and concessional period is 25 days. Option C say NDD is on September 8 and concessional period is 85 days. And option D say NDD is on 8 September and concessional period is 60 days. So there are your options. So before we break down the solution, let me ask you a quick question. Where when you hear this term Ujans or DA bill, either we call it Ujans or DA bill, when you hear this word Ujans, right, with a Ujans period mentioned, do you think that the bank's calculation for the due date include an additional period beyond the Ujans period itself? Do you think that bank's calculation for the due date include an additional period beyond the Ujans period? Type yes if you believe that there is an extra period, or type no if you think that it's just the Ujans period. Let's see what you think. So do you think that when you hear this word Ujans, do you think that bank calculation for the due date include an additional period beyond the Ujans period? Yes, great, right? So great insight, right? Interesting viewpoints. Obviously, option A, yes is the correct, because in the case of Ujans bill, Ujans period is there, but in addition to the Ujans period, there is some extra period which is provided, right? So what is your response? What do you think is correct here? A, B, C, D? Because such question will be asked in the examination, and that is why we are doing practice here. No issue if you make it incorrect, because in the real examination it should not go wrong. That is our main motive. So option C you are saying. Okay, fine. So let's break down how we arrive at the correct answer. Let's break it down. So, friends, that for a Eugen's will, the first of all, you should have conceptual clarity. For Eugen's will, I think this is, let me solve it here. Okay, okay, fine. Just wait a minute. Okay, that for Eugen's will, the bank calculate NDD. What is NDD? Notional due date. By adding NTP to the Eugen's period. What it does, it add NTP plus Eugen's period, right? So in what is NTP? NTP is 25 days. We know it very well. 25 days is NTP, and Eugen's period given is 60 days, right? And clearly written, no grace period allowed. Sometimes there is some grace period also allowed, but here in the question clearly written that no grace period is allowed, right? So what you will do, you just add these two. So what you will do, 25 days plus 60 day, which is 85 days, right? This means the NDD is 85 days from the submission date. And that what about the concessional interest rate? The concessional interest rate apply for the entire period for which advance is extended. So the total period is 85 days, right? It apply to the entire period for which the advance is extended, right? So the concessional rate is available for 85 days. Now let's apply the date here. Let's apply the date. Although the exact calendar date require counting through the month, our key focus is on period. So let's start with the June 15. So let me show you here. June 15, right? So first you write June 15 plus 85 days. So approximately you will reach, so 30 days, after 30 days you reach July 15. After 30 days you reach August 15, 60 days cover. After 25 day you will reach September 8. 8 September you will reach, right? 8 September you will reach. So this confirm that notional due date is 85 day from June 15 and concessional period is 85 day. Option C is perfect. Very good. Very nice to see you have responded correctly. Option C is the correct answer. I request other member to also type their answer, because such questions are most frequently asked in the examination, and you should have conceptual clarity. How to go about solving the case of Eugen's bill, how to go about solving the case of the uh, demand bill, right? So why do you think, right? So is it clear now why the answer is 85 days? That did everyone feel clear about how we arrive at NDD being 85 days? Type yes if you are clear, or type no if you'd like further clarification on any part of the calculation. Is it clear that how we have calculated this 85 days? If it is clear, type yes in the chat. Otherwise, type no. I will again explain it. So two key concept which we have learned in this particular question is that this particular concessional period is applicable for the entire period, right? For the side bill it is NTP, and for the Eugen's bill it is Eugen's period plus NTP. I want responses from your side. I hope it is clear, right? I am getting that yes, it is clear. Very nice. Okay, fine. Now let's move to the next question. So the next question is on your screen. Very nice question it is. Let me explain it for you. Here is the scenario for the next question, as you can see. So the question say DEF export unexpectedly receive a large export order with USD 2 million for high value perishable goods. Since the order was not planned in their annual projection, DEF Export approved their bank seeking an adjustment in the standard inventory norm to manage the order effectively. Please read it again. This is the scenario presented before you. So what it does, it receive a large export order, right? So it is an exporter. It receive an order of 2 million US dollar, right? And the goods are perishable. Order was not planned in their annual projection, and DEF export approaches their bank seeking an adjustment. So now, I hope you have gone through this particular question. Let's see the first option, first question based on this scenario. The first question is, based on the bank policy, which of the following statement best describe how the bank is likely to handle the inventory norm for DEF export in this situation? Option A say that bank will enforce the existing inventory norm strictly regardless of the order's characteristics. Option B say the bank may relax the inventory norm by considering both the size and nature of the export order. Option C say that bank will relax the inventory norm only if the exporter holds a gold card. Option D say the bank will only consider relaxing the norms if additional collateral is provided by the exporter. So this is the case. I hope you have seen the situation also that it received a large export order of USD 2 million for high value perishable goods, right? Now tell me what do you think is the correct answer? Take a moment to think about it and type your initial answer in the chat. Which option do you lean about and why? Please type whatever you think is correct. No need to hesitate, right? A, B, C, D. Because you know the mistake which we'll do here, this will help you to understand your clarify your concept, and this concept you will use in the examination, which will help you to solve the question correctly, right? Okay, so I can see some interesting response coming in. Someone is saying C, option C. Someone is saying option D. Okay, great. Now, let's break down the option one by one. Option A says that bank will enforce the existing inventory norm strictly, regardless of the order characteristics. Right? Enforcing norms without considering the specifics of the order does not usually align with a flexible banking policy. Right? You are enforcing the norm without considering the specifics of the order. It does not usually align with a flexible banking policy. Bank often adjusts terms when the order is unusual in size or nature, especially for a perishable high value good. So do you think that a bank would stick rigidly to the norms even if the order is unexpected and perishable? What do you think? Yes or no? Do you think that bank would stick rigidly to the norm even if the order is unexpected or perishable? What do you think? That a bank would stick rigidly to the norms? Obviously no. Yes, correct, it is no. Now let's see the option number B. So option A is wrong. Option B says that the bank may relax the inventory norm by considering both the size and nature of the export order. So this option reflects a flexible approach. Bank understand that an unexpected large and perishable export order may require adjusted inventory norms to manage risk effectively. And the bank is likely to look at both the magnitude of the order and its specific characteristics. Right. Now let's see the option number C. Option number C says that bank will relax the inventory norm only if the exporter holds a gold card. While holding a gold card might offer additional benefit, in some cases, this option limits the policy to one specific condition, which is not typically the sole factor for adjusting inventory norm. So a gold card is not the only criteria, right? Gold card is not only criteria. Gold card is a criteria. While holding a gold card might offer additional benefit in some cases, the option limits the policy to one specific condition. So do you think a gold card is the only criteria for relaxing norm? The answer is no, right? And lastly, option number D. It says that bank will only consider relaxing the norm if additional collateral is provided by the exporter. See, requiring extra collateral might be a part of risk management, but in this scenario, the bank decision is more likely to be driven by the order characteristics rather than the extra collateral. Right. So, can you tell me, should additional collateral be the only basis for relaxing inventory norm? The answer is no. Right. So, the correct answer is option number B here. Neither C nor D. The correct answer is option number B. Right. In this situation, the bank is likely to relax the standard inventory norm by considering both the size and nature of the export order. Since DEF export received a large unplanned order for high value perishable good, The bank recognizes that strict adherence to the standard norm may not be practical or fair. Instead, the bank will assess the risk by looking at two things. First thing they look at is the high size of the order, which is US dollar 2 million, which is a significant size of the order. And the second thing is look at the specific nature of the goods, which is a perishable goods, which require a special handling. This flexible approach help manage risk while supporting the exporter unexpected business opportunity. So does everyone feel clear about why option B is the best description of the bank likely approach? Please type yes if you understand, or type no if you have further question or need more detail. What do you think? Have you understood it? Why option number B is correct here? Okay, very good. I hope it is clear now. Now let's see the next question. I think one more question based on the same. Yeah. So this is another scenario. Uh, Before you, the question is GHI Export, a long-standing client with an impeccable credit record and gold card status, need to renew its existing packing credit limit. They have submitted the renewal request to the bank. At the same time, bank is known to give preference to the gold card holder and process different type of credit application within the space. So this question is basically focused on gold card status. If you know about it, then you can answer it quickly. So let's see the question. The key concept is that GHI exporter has a good credit record and a gold card status. Now, let's see the first question. Which of the following best describe the bank processing timeline for GHI export renewal request, and what additional preferential benefit might they expect as gold card holder? All of you, please try to answer. Option A say that the renewal request will be processed within 25 days, and as a gold card holder, they will automatically receive a higher credit limit. Option B say the renewal request will be processed within 15 days, and gold card holder are given preference in granting packing credit in forward currency. Option C say that the renewal requests are processed within 7 days, and gold card holder may be exempted from all collateral requirement. Option D say the renewal request will be processed within 15 days, but gold card status has no impact on processing speed. So before we jump into the answer, please take a moment to think about what you might expect in terms of processing timeline and benefit. Feel free to type your initial thought in the chat. What do you think the answer is? Feel free to type your chat, whatever you think is the correct answer. Feel free to type. So this question revolves around the gold card holder, right? What are the relaxation in processing time, and what are the benefits that they get? So let's break down each option. I see many of you leaning toward option B. That's interesting to see. Now I request you please type your thought in the chat. Right now, let's see the option. Let's break down each and every option. So first of all, option number A says that the renewal request will be processed within 25 days. Right. So although a high credit limit might be a potential benefit, the processing timeline here is too long compared to the guideline for renewal request. Bank usually process such renewal faster for premium client. Do you think that 25 days is a typical processing period for renewal request for a gold card holder? Please type yes or no in the chat. Is 25-day typical processing period? Type yes if it is and type no if it is not. What do you think? Is 25-day typical time period for processing the gold card for processing gold card status holder? The answer is no, right? So that is why option A is wrong. Now let's see the option number B. Option B says that renewal request 15 days, and the gold card holder are given preference. So this option aligning with the bank guideline. For renewal request, the processing timeline is 15 days. You should know it. How much is the processing timeline? It is 15 days, right? And you know that gold card holder, right? They benefit from preferential treatment, especially in granting of packing credit in foreign currency, right? So that's why option number B is the correct answer. 7 days is also wrong, right? 7 days. Option C says that it should be processed within 7 days. This is a very fast turnaround. It might seem appealing initially, but 7 days is too short based on the bank standard processing time, right? So 7 days is wrong. And option D says that it should be processed with why option B is correct. Is it clear now? I hope I'm audible and you are able to hear me, hear my voice. Is everything okay? Please type okay in the chat so that we can continue our session. Yeah, I hope everything is okay, right? You are able to see the screen, audio and video are okay, right? So the correct answer is option number B here, 15 days. And they are given preference by granting packing credit in the foreign currency. These two are the key condition, right? So please type okay if you think that everything is clear, everything is audio and video are okay for you, because I think there was slight disconnection in between. Okay, let me see some responses coming in. If everything is okay, please type okay in the chat. Now let us move to the next question. Now, this is the second question scenario, because whatever question we are dealing in today's session are asked in the previous year, right? So please give a special attention. Yeah, I everything is okay. Please give a special attention to this question, because I have selected a few question. I have selected a few topic from where question have been asked in the previous year, and that is what I am presenting before you. So there is a large chance of this question again repeating in the examination, right? So the first question is, Sunrise Export, a leading exporter in India, has recently entered into a factoring agreement. So this question is regarding factoring agreement. So the Sunrise Export has recently entered into a factoring agreement with a financial institution. Under this agreement, the factor agrees to purchase export book debt generated from sale made on an open account basis. In addition to buying these receivable, the factor also monitored the credit extended to the exporter's customer and manages the sales ledger. Recently, due to slowdown in a customer payment, Sunrise Export is facing liquidity challenge. So this is the scenario. Now let's see the first question. The first question is, in the context of factoring, which service provider provided by the factor is most critical in immediately addressing the Sunrise Export liquidity issue? We know that this Sunrise Export faces some liquidity issue, clearly written that due to slowdown in customer payment, it is facing liquidity challenge. Now question is, which service provided by factor is most critical in addressing this liquidity issue? Let's go through the option. Option A says administering the sales ledger, because maintaining accurate record ensures efficient monitoring of all transactions. Option B says controlling the credit extended to the customer, because it helps in preventing future default. Option C says purchasing the book debt from Sunrise Export. And option D says advising on market trend and customer behavior. So which is the most, all these four options are the function performed by factor, but which is the most critical factor, critical function, right? That is what is asked regarding the factoring. A, B, C, and D. Type your thought in the chat. What do you think? So my first question is, do you think that accurate record keeping would solve immediate cash flow problem? Type yes or no. Do you think that immediate accurate record keeping would immediately solve cash flow problem? Just type yes if you think that immediate accurate record keeping would solve the liquidity problem. And if you don't think so, please type no. See, that is what option A is telling, right? Option A is telling what? Administering the sales ledger, right? Maintaining an accurate sales ledger is important for keeping track of the transaction. However, while it ensures record are up to date, it does not directly convert receivable into cash. We have receivable, it does not directly convert. In factoring, what we have something called receivable. I think you know about it, right? So we have receivable, but if you are maintaining our sales ledger correctly, it does not mean that our receivable will automatically convert into cash. So that is why option A is incorrect. Now my second question is, would you say managing credit risk directly address today's cash crunch? Managing credit risk would address the cash crunch? That is what option B is all about. Would you say that managing credit risk directly addressed cash crunch? Yes or no? What do you think? If we address credit risk, will it automatically address our cash crunch or liquidity issue? The answer is, that is what option B is about. It says that controlling the credit risk extended to the customer. You know that this service help mitigate future risk by preventing defaults. Yeah, yet it is more about reducing future risk and not about immediate liquidity. Because what problem this exporter is facing? Liquidity crunch, right? But suppose the option B says that if we control credit risk, our problem will be solved. That is not correct, because you know that we are controlling credit risk only, right? It will not provide immediate liquidity needs. So that is why option B is also incorrect. Now, option C says that purchasing the book debt, right? So, does converting receivable into cash sound the fastest way to resolve cash crunch? Tell me, what do you think? Option about option C. If we convert the receivable into cash, we have receivable, right? You know it very well. We have receivable. So, if we convert the receivable into cash, would it solve our cash crunch issue? That is what option C is saying. Purchasing the book debt from the Sunrise Export. Does converting receivable into cash sounds like the fastest way to resolve a cash crunch? Let me know your thought in the chat. Type yes or no. That's what option C is saying. Now, it is saying purchasing the book debt from the Sunrise Export. Right. Obviously, yes. Right. Because this is the core function of factoring. You see this option C. This is the core function. This is the core function of factoring. Right. Why? Because by purchasing the exporter receivable, the factor convert future cash inflow into immediate cash. This directly address the liquidity issue, especially when customer payment are delayed. Right? That is why option C is the perfect answer here. Because this Sunrise Export is facing liquidity issue, and when this factor purchase the book debt, it will automatically solve the problem. And option D says that advising on market trend and customer behavior. While that strategic insight are valuable for long term business performance, they do not directly solve short term liquidity as well. Because what is the main issue here? The main issue is here short term liquidity problem, right? If we provide insight, it does not solve our issues, right? So, based on our discussion, the correct answer is option number C. You should know that the key purpose of factoring is to convert receivable into cash. What is the meaning of receivable? What is the meaning of this term receivable? You might heard this term again and again. Receivable. Receivable just means exporter book debt, right? So, in the case of Sunrise Export, where delayed customer payment have led to liquidity issue, because that this Sunrise Export is not receiving payment on time, and that is why this delayed customer payment has led into this liquidity issue. So in this case, the most critical service provided by the factor is purchasing this book debt. Besides this purchasing of book debt, factor also provide other service like administering the sales ledger, controlling the credit extended, advising on market trend. But in this particular case, right, option C is the perfect answer. Does everyone feel clear about why purchasing the book debt is the critical service in this situation? Please type yes if it is clear, or no if you have any further question or need further clarification. Because these questions are super important. They are asked every year in the examination. You should know the function performed by factors. So if it is okay, please type yes so that we can move to the next question. I hope it is clear. You all have understood that what is the basic thing. Yes, okay, very nice. Let's see the next question we have. So this is the next question, very interesting one. Please go through it. So here's the scenario. If you have any doubt, please feel free to chat in the put your doubt in the chat box. Now the question is, Global Trader Private Limited, an Indian importer, needs to make an advance remittance of US dollar 1,80,000 for importing a specialized machinery. The overseas supplier insists on advance payment and has provided detailed documentary evidence showing the cost of good. Global trader hold a valid exchange control copy of the import license and goods are not on the negative list. So this scenario has been presented before you, that he is an Indian importer. He need to make an advance remittance of this much amount for importing this machinery, and the supplier insists on advance payment and has provided detailed documentary evidence showing the cost of good, and this global trade hold a valid exchange control copy of the import license. I hope you have gone through this scenario. Please take a screenshot of it, because most of the question will be based on this scenario only, right? So let me tell you the first question. The first question is, based on the AD's guideline. You know what is AD? AD stands for authorized dealer. Based on the AD's guideline, which of the following is correct regarding the processing of global trader advance remittance? Option A says that the remittance cannot be processed as it is below the threshold and require additional verification. Option B says the remittance is allowed without any requirement for a guarantee, provided the documentary evidence and valid import license are verified. Option C say that the remittance must be accompanied by an irrevocable standby LC since it exceeds 1 lakh US dollar. And option D say the remittance is only allowed if a guarantee from an international bank is obtained, regardless of the amount being under 2 lakh US dollar. This is an advance remittance which an importer is giving to a foreign supplier. Take a moment to think about it. Which option might be correct? What do you believe and why? Please type your answer A, B, C, or D in the chat. Don't hesitate to type the correct answer, because once you think whatever you see correct, please type. We will see the thought process. We will how to go about solving such type of problem, right? What should be the thought process? What is the concept behind it? Okay, so let's discuss this particular question. Let's discuss each and every option. So let's start with the option A. So option A says that the remittance cannot be proceed as it is below the threshold and require additional verification. Do you think that below the threshold would cause extra hurdle? Type yes or no in the chat. Do you think that below the threshold would cause extra hurdle? See, the guidelines actually permit remittance up to, what is the guideline permit? No, yes, the guideline permit remittance up to US dollar 2 lakh. This is the guideline permit that you can remittance, you can permit remittance up to US dollar 2 lakh when proper documentation is provided. And the global trader had supplied detailed documentary evidence, and he also hold the import license, right? So the option is that remittance cannot be proceed as it is below the threshold limit. No, this is wrong, because you know that this is the limit. 2 lakh US dollar is the limit. The guideline actually permit remittance up to 2 lakh. That yes, up to 2 lakh remittance can be done. So the option A is wrong, right? Option B says that the remittance is allowed without any requirement for a guarantee. Now, let me ask you a question. The question is, does converting your receivable into cash immediately without extra guarantee sound like a standard benefit for such a transaction? Type yes if you agree, or type no if you have reservation. Now let me again rephrase the question. You are converting receivable into cash immediately. Does converting your receivable into cash immediately without extra guarantee sounds like a standard benefit for such transaction? That is what option B is saying now. See it, what it say, that remittance is allowed and without any requirement for a guarantee, right? So basically what you are doing, you are converting the receivable into cash, right? So this option align perfectly with the guideline. Advance remittance up to US dollar 2 lakh, right? Advance remittance up to US dollar 2 lakh are allowed once the importer provides satisfactory documentary evidence, first condition, including the cost detail and the supplier insistence on advance payment, right? And he should also hold a valid import license, right? So you should know that in no any additional guarantee is needed for amount under US dollar 2 lakh, right? So this is all about option B. Option C says that the remittance must be accompanied by irrevocable standby letter of credit since it exceeds 1 lakh. So what is the threshold? The threshold is 2 lakh dollar, right? Not 1 lakh. So this option is incorrect. And option D says that, right, the remittance is only allowed if the guarantee from international bank is obtained, right? So this is also incorrect, right? So the correct answer is option number B. Based on our discussion and guidelines, the correct answer is option number B. So let me give you the key point here, that according to the authorized dealer guideline, advance remittance up to 2 lakh dollar can be processed when the importer provide, first thing, the first condition is that he should provide what? You can see the answer here. Option number B is here, right? So the first condition is that he should provide satisfactory documentary evidence. The first thing is that, and no additional guarantee is required. In this case, no additional guarantee is required, right? Below US dollar 2 lakh, no additional guarantee is required, right? So since global trader is remitting how much? He is remitting, this firm is remitting $1,80,000 and all conditions are satisfied. So the remittance is allowed without any additional condition. So does everyone understand why option B is correct? Type yes if it is clear, or type no if you have any question. Right, based on this scenario we have discussed, since he is remitting $1,80,000, so that's why option number B is correct. Is it clear now? Okay, fine. I see that this concept is clear to you, that two things are necessary, that satisfactory documentary evidence and valid import license. If, and the threshold limit is 2 lakh, 2 lakh dollar, right? If these conditions are being followed, then nothing extra is required, no any guarantee is required to do this advance remittance for the import, right? I hope it is clear. Please, all of you, please type yes in the chat. Now let's see the next question. So this is another question before you. Let's go through it. So the question is, Innovate Import Limited, an Indian importer, planned to make an advance remittance of US dollar 3 lakh for a bulk order of raw material. The supplier has provided the necessary cost documentation and insists on advance payment. Innovate Import hold all required license and is compliant with exchange control regulation. However, as the remittance exceeds 2 lakh, the bank internal policy require additional reassurance. Right, just now we have talked about it. So please read it once, that here the advance remittance of 3 lakh dollar is being made. In the previous case, yes, I think previous question was clear to you. Now in this case, you can see that remittance of 3 lakh dollar is being made. In the previous case, we have seen 1,80,000 was made. Now let's go through the question. The question says, under the AD's guideline, which condition must Innovate Import Limited satisfy to process this advance remittance of 3 lakh dollar? So conditions you have been asked. Option A say no additional condition are required beyond the documentary evidence and valid import license since the amount is below 5 lakh. Option B say an irrevocable standby letter of credit or a guarantee from an internationally reputed bank must be provided unless a board approved policy apply to waive the guarantee requirement within 2 lakh dollar to 5 to 50 lakh dollar. Option C say the remittance can only be proceed if the supplier agree to lower the remittance amount to under 2 lakh. And option D say a waiver from Ministry of Finance is required because the remittance amount exceed 1 lakh dollar. So please type your initial answer A, B, C or D in the chat. What do you think? It is the extension of the previous question which we have discussed. The threshold was 2 lakh, you know it very well, right? So what happened if the advance remittance is larger than 2 lakh? What are the conditions to be fulfilled? That is what the question is asking. Okay, please type. This is a quite easy question, right? We have just discussed it. I provided you a hint also. In the previous question, I have provided you sufficient hint, right? So you can easily answer it. Okay, so let us go through the option. Let's discuss each option in detail. Option A says that no additional condition are required. See, while documentary evidence and valid import license are necessary, they are not sufficient when the remittance exceed $2 lakh. You know this is the threshold, $2 lakh. When the remittance exceed $2 lakh, this is not sufficient, right? The guideline specifically require extra assurance, right? So it is say that no additional condition are required. So this is wrong. Option B says that an irrevocable standby letter of credit. So this option accurately reflects the AD's guideline. You know that for advance remittance exceeding $2 lakh, right, bank require an additional guarantee, either an irrevocable standby letter of credit or a guarantee from an internationally reputed bank. And also there is a provision for a board approved policy, right, to waive this requirement within this range. If the board approval policy is there, that yes, that we have to waive, they can waive the requirement, guarantee requirement under the limit $2 lakh to $50 lakh, right? So does the idea of providing a guarantee or letter of credit sounds like a practical method to secure such a transaction? Obviously the answer is yes. That is why option B is the correct answer here. So if the advance remittance amount exceed $2 lakh, so an irrevocable standby LC or an board approved policy, right, should be there, right? Then only this condition must be satisfied to process the advance repayment, right? This acts like an extra security. In this case, this condition act like an extra security, right? So option C says that the remittance can only be proceeded if the supplier agree to lower the remittance amount to $2 lakh, right? So this is option C. This option is not correct because the importer is not required to reduce the remittance amount. Instead, they must meet the additional guarantee requirement. No guarantee requirement under $2 lakh, guarantee requirement above the $2 lakh. And what are the possible options we have just seen? And option D is also correct, also incorrect, because you know that Ministry of Finance, this option misrepresent the condition, right? Ministry of Finance is nothing like that. There's nothing like that, right? So you must remember that since the remittance is amount is $3 lakh, which exceed the threshold, which is $2 lakh. So the bank internal policy require additional assurance, right? So this is the correct answer. Let me show you, right? This is the correct answer. Option B is the correct answer. So does everyone understand why option B is correct answer in this particular question? Please type yes in the chat if it is clear. If the concept is clear, what are the conditions to be fulfilled? Basically, here extra assurance is required, extra guarantee is required, right? Either in the form of irrevocable LC or in the form of we have just talked about the irrevocable LC here, and the second form they can do is a board approved policy should be there, right? So this is the condition. Now let's see the next question. I hope everyone has understand the previous question that threshold limit is $2 lakh. Below $2 lakh, just import license copy and documentary evidence is sufficient, and above $2 lakh, do you require an extra guarantee? That is the main point of the question. Now let's see this question. The question is ABC Import Limited, an Indian importer, had remitted foreign exchange for an import transaction through an LC. Once the goods have arrived in India, ABC Imports submit to his authorized dealer an exchange control copy of the bill of entry along with a postal appraisal form. And the AD is required to verify and record this detail. So this is the scenario presented before you that that foreign exchange has been remitted through an LC. Goods has arrived in India. ABC Imports submit to its authorized dealer an exchange control copy of the bill of entry along with the postal appraisal form. Right, now let's see. Let me show you the question. The question is which of the following is not a part of the AD's responsibility in processing the evidence of import for this transaction. So which of the following is not a part of the AD's responsibility? That's the authorized dealer responsibility. Option A say cross checking the particular in the bill of entry with the detail of the LC. Option B say issuing an acknowledgement slip containing all detail of the bill of entry received by the receipt from the importer. Option C say preserving the original bill of entry or its summary for verification by the internal auditor or RBI inspector. Option D say waiting for a separate BEF statement from the importer before recording the evidence of import. So which is not a part of the AD's responsibility? This question is regarding this. Take a moment to think about it, and when you are ready, type your answer A, B, C, or D in the chat. So not a part. Read the question carefully. It is not a part I've been asking. Means three options should be a part and one option should not be the part. Right. So this question is based on evidence. What are the responsibility? Right. So while you are thinking about your answer, here is an intermediate question for you. Why do you think it is important for the AD to preserve the original bill of entry or summary? Right. Obviously, this preservation is required. Right. So, so some of you are answering option number D. Right. Thanks for sharing your insight. Now let's look at the correct answer for our main question. Let's break down. Let's see the option number A. Option number A says that the AD is indeed responsible for cross. Yes, this is correct. The AD is indeed responsible for cross-checking the particular in the bill of entry with the detail of the LC. This is the key verification step. Option B, it says that issuing an acknowledgement slip containing all the detail of the bill of entry. Right. So this is also a part, because issuing an acknowledgement slip that record all detail of the bill of entry is also a part of the AD's responsibility. So this is also correct. Now, preserving the original bill of entry or its summary for verification by the internal auditor and RBI inspector. Yes, this is also correct. That the AD must preserve the original bill of entry or its summary to facilitate future verification. And option D says that waiting for separate BEF statement. However, AD is not required to wait for a separate BEF statement from the importer with the you have heard about this IDPMS. You might have heard about this IDPMS. With the operationalization of this IDPMS, all outstanding import remittance are reported directly into the system. Since this system has been operationalized, now no need to have a separate. There was a requirement of separate BEF statement, but once this system has come into picture, right, then there is no need for all. What happened, all outstanding import remittance are reported directly into the system, and separate BEF statement has been discontinued. So option D is not a part. So great to see that you have answered it correctly, right? Yes, very good. Yes, RBI audit is required. Very good. Yes. So option number D is the correct answer. Earlier, this used to be a requirement, that is a separate BEF statement, but now there is not so requirement, right? So the correct answer is option number D. That is, waiting for BEF statement is not a requirement. So great job, everyone. Right. So does anyone have any question or comment about this process? I hope it is quite clear or quite easy to understand. So let us move to the next question. So is it clear now? Please tell me, what are the conditions to be fulfilled? What are the responsibilities of AD we have just discussed now? So option D is now not a responsibility, right? Earlier it used to be. Please type yes if it is clear. Let me move to the next question. So here it is. The next question is in front of your screen. Yeah, here it is. XYZ Limited is a company listed on a stock exchange with a net worth of 150 crore as per its last balance sheet. For an import transaction, XYZ Limited remit foreign exchange amounting to US dollar 9 lakh. Sorry, it is 9 lakh. Instead of submitting the exchange control copy of the bill of entry, the company provided a certificate from its CEO certifying that goods for which the remittance was made has actually been imported to India. So this is the condition here. Yes, yes, I will provide. Yes, I'm looking forward to conduct class on the in the morning. So if you all of you agree that 7:30 to 8:30 or 7 to 8 is okay for you, then we can conduct more classes, right? If all of you are satisfied with the timing, because we can take the classes in the morning only, right? If you are okay with 7 to 8 or 6:30 to 7:30, whatever you say, or okay, yes, yes, we can conduct such classes, because solving such type of question, solving such type of question will provide you insight. You will no need to what happened. Yes, yes, I will try, because this way, this case study type question will help to retain the concept, right? Okay, 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 I will share the detail. Yes. So now let's see this question. This question is regarding the as you can see clearly, this question is about XYZ Limited is a company listed on stock exchange. Net worth is 150 crore. An import transaction, it remit foreign exchange amounting to 9 lakh. Instead of submitting the exchange control copy of the bill of entry, the company provided a certificate from its CEO. Right. So, based on the guideline, which of the following statement is correct? So, let me show you the question. Based on the guideline, which of the following statement is correct regarding the AB's acceptance of XYZ limited evidence of import? Right. Option A say that AD must reject the certificate and insist on the exchange control copy of the bill of entry regardless of the company status. Option B say the certificate from the CEO is acceptable only if it is accompanied by the original bill of entry. Option C says the certificate from CEO is acceptable provided that the remittance is less than $1 lakh and the company meets the net worth requirement. And option D say the certificate is acceptable only if it is issued by the auditor, not the CEO. So what do you think is correct? Take a moment to review the question. So let me show you the scenario once more that net worth is 150 crore, remitted 9 lakh foreign remittance. Instead of submitting the exchange control copy, the company provided certificate from CEO. Now the question is which statement is correct regarding the acceptance of XYZ limited evidence of import? Okay, so one answer I am getting is option number A. So while you are considering your answer, why do you think that net worth of a company and amount remitted play a role in determining whether the alternative evidence, like a certificate from CEO, is acceptable? So here the two key things are: the first thing is net worth of a company, and the second thing is amount remitted. Right? These two things. So answer I am getting is option A. So let us see. Let us go through the each and every option. You know, these two things are super important: net worth criteria, and the second thing is certificate from CEO. So let me tell you the correct answer to this particular question. You know that it has net worth of how much? 150 crore, right? Net worth is 150 crore, you can see, which is well above the. And what is, you know, what is the minimum requirement? The minimum, can you tell me what is the minimum net worth for a company to be listed on a stock exchange? That is 100 crore, right? 100 crore is the minimum net worth, minimum requirement for a company to be listed on a stock exchange. And this qualify the company under the guidelines that allow alternative evidence. So if a company has a net worth larger than 100 crore, right, it can be able to, right? So these qualify the company under the guideline that allow alternative evidence. Now let's talk about the remittance limit. The guideline says that if the foreign exchange remitted is less than 10 lakh, listen me carefully, if the, just wait a minute, I think it is, yeah, 10 lakh. So guideline says that if the foreign exchange remitted is less than 10 lakh USD, 10 lakh USD, right, or its equivalent, the AD may accept a certificate as an alternative to the exchange control copy. So the first thing is that net worth should be larger than 100 crore. Second condition is that it should be less than 10 lakh. What should be less than 10 lakh? That means advance remittance. In this case, what it is? 9 lakh. So this condition is also satisfied. So in this scenario, we can say that XYZ Limited remitted 9 lakh, which is below the US dollar 10 lakh threshold. So this is the threshold, right? And the certificate provided by the CEO therefore meets the criteria. Now let's go through the option. So the option number A says that the AD must reject the certificate. No, this is wrong. Option A is wrong. Option B says that the certificate from CEO is acceptable only if it is accompanied by the original bill of entry. No, this is also wrong, right? Option C says that, right, that the certificate from the CEO is acceptable provided that the remittance is less than. Yes, correct. Net worth requirement is fulfilled here because, you know, 100 crore is the, it should be above 100 crore and it has 150 crore. The first condition is fulfilled, and remittance is also $9 lakh, which is less than the $10 lakh. So though both the conditions are fulfilled, that is why the certificate from CEO is acceptable. So this certificate can act like an alternative to the bill of entry. You know, this bill of entry, every importer has to provide this bill of entry, right? But if it does not have, then they can have the certificate from the CEO, but two conditions must be fulfilled. The first condition is that net worth should be higher than 100 crore, and second condition is that the remittance should be less than 10 lakh dollar, right? So that is why option number C is the perfect answer for this particular question, right? So is it clear? Option D says that certificate is acceptable only if it is issued by the auditor, not the CEO. This is wrong, right? Is it clear? Why option C is correct? Please type yes, it is clear, or if you have any question, right, please type. Okay, I hope, yeah, it is clear. It is clear now. Now let's see the last question of today's session. This is the last question of today's session. Although we have many questions left, we will try to cover in the next session. Right. This is the last question. Let me show you the question. This question is about take equip an exporter of industrial machinery, ship capital good to global industry under supplier credit term. Instead of immediate payment, global industry is granted a credit period up to 3 years from the shipment date. To improve liquidity, Take Equip finance the shipment by discounting its bill with the bank, remaining liable if global industry fails to pay on maturity. The shipment value is $40 million, okay, which is within the 50 million limit per transaction. Again, read it carefully. Capital good is shipped to global industry, right, under supplier's credit. So here is the keyword supplier's credit. So obviously, Take Equip is exporting something to global industry. So global industry have to make the payment, but he is granted a credit period of 3 years from the shipment date. And to improve the liquidity, Take Equip finance the shipment by discounting it bill. So what it does, Take Equip finance the shipment by about discounting it bill. What Take Equip does, Take Equip has the bill with it. So it goes to the bank. It tells the bank that take this bill right now and finance me at discount, right? And when the bill mature, you take collection from the global industry. That is what is happening here, right? And the shipment value is how much? $40 million. Now let's see the first question. Given the goods are shipped are the capital good, clearly written that goods are capital goods. What is the applicable credit period under supplier's credit term? And why is this said the way? Option A say up to 1 year or the operating cycle, whichever is less, because capital goods need a shorter credit period. Option B say up to 3 years from the shipment date to accommodate the longer financing need of capital goods transaction. A fixed period of 6 months, irrespective of the types of good to reduce the risk, and negotiable without any set limit. So, what is the applicable credit period under supplier credit term? That is the question. And why is it is said this way? So, what do you think? A, B, C, or D? Given the goods is of capital goods. So, before you answer this question, why do you think that transaction involving capital good might require a longer credit period compared to other type of good? Can you tell me why transaction involving capital goods required a large longer credit period as compared to other types of goods? Obviously, we can see that the case is was capital good. What do you think? Actually, the answer to this question is written in the scenario itself. That the scenario which we have seen in that also the answer was written. So I think most of you can easily answer it. A, B, C, or D. What do you think? Yes, more operating cycle. Yes, correct. See, industrial machinery. This is the perfect example of capital good, right? So the capital good, like the suppose industrial machinery, which was shipped by Take Equip, it has a higher value and also it has a longer payback period, right? So to account for these two factors, because the value is higher and the second reason is that payback period is also higher. So to account for these factor, supplier credit it extended up to 3 years from the shipment date, right? So the answer is 3 year. Option number B is correct. The supplier credit is extended up to 3 years. This extended period is specifically designed to provide sufficient time for the importer to generate return from the use of this high value good, right? Because these are high value good, so importers should be given time to generate return, right, thereby facilitating their ability to meet the payment obligation. Obviously they have to pay more, right, because the goods are of high value. So it provide the importer a sufficient time to generate revenue, right? Now let's see the option A and C. So option A says that a shorter period of one year. Option C says that 6 months, so which are not in line with the need for the capital good transaction, right? So that is why option this is the correct, right? So option number B is correct. You should remember that it is 3 year for capital goods, right? And here is the scenario. Okay, so we will cover the next question in the next session. I hope this make your concept clear, right? So that's all for today. So please type helpful if the today's session was helpful, right? And we will reconsider your request of conducting the session daily basis. I'm thinking about it, right? So I will share this particular PDF in the group, and also the live recording session will be available in the course, so that you can go through this question again, right? We have covered some important aspect related to the unit number 5, and some, some numerical portion is left. At the end of the book of unit number 5, you will see some numerical portion, some case study. So we will cover in the next session, right? So we are covering each and every chapter bit by bit. Till now we have started from unit 1 and currently in unit 5. We will continue like this, right? So that's all for today. Thank you for attending the today's session. I will send the I will provide you the detail regarding the next session in the group itself. So be ready to keep watching the notification which I provide in the Telegram group time to time. Thank you.